In today's automotive market, dealerships and manufacturers want you to believe that trucks are the ultimate investment, reliable, durable, and holding their value better than any other vehicle segment. They tout impressive towing capacities, rugged looks, and premium features while glossing over the financial devastation that's about to hit your bank account the moment you drive off the lot. What they don't want you to know is that we're experiencing an unprecedented collapse in truck values that makes even luxury car depreciation look tame by comparison. I've spent months analyzing dealer auction data, interviewing used car managers, and tracking thousands of truck listings across the country. What I've uncovered is shocking. Certain trucks are losing up to 65% of their value in just a few years, with some models experiencing value collapses so severe they're redefining what we thought we knew about vehicle depreciation. These aren't just minor price adjustments, they're financial catastrophes for owners who believe the marketing hype. You might assume that truck depreciation follows the normal rules of the automotive market, a gradual decline over time with reliable brands holding value better than others. That's the comfortable story that dealers, manufacturers, and even most automotive publications continue to push. But the data tells a completely different story, one of sudden value cliffs, overnight price collapses, and depreciation patterns that defy traditional logic. What's particularly alarming is how this crisis is affecting trucks that were previously considered safe bets. According to wholesale auction data that dealers don't want you to see, even trucks from brands with legendary reliability reputations are experiencing unprecedented value declines. The patterns emerging from this data don't just challenge conventional wisdom about truck ownership, they completely shatter it. And perhaps most disturbing of all, these value collapses aren't happening gradually over a decade. They're occurring in compressed time frames that leave owners underwater on loans before they've even made 2 years of payments. Which trucks are experiencing the most catastrophic depreciation in today's market? What hidden factors are causing certain models to lose over half their value in record time? And most importantly, how can you avoid becoming the next victim of this financial bloodbath if you're currently shopping for a truck? Let's dive into the 8 trucks that are worth virtually nothing compared to what buyers paid for them and uncover the shocking reasons behind their collapse. 1. Nissan Titan XD, the dead truck. The Nissan Titan XD represents perhaps the most complete failure in modern truck history, a vehicle that the market has decisively rejected. While all vehicles depreciate, the Titan XD's value trajectory isn't just declining, it's in free fall, losing an astonishing 64 to 65% of its value within just 5 years of ownership. Let's put that in perspective. Someone who purchased a well-equipped Titan XD for $55,000 is now looking at a market value of approximately $19,000 after just 5 years, a loss of $36,000. That's not normal depreciation, it's financial devastation. The mathematics work out to roughly $600 in lost value every month for 5 straight years. The collapse stems from a perfect storm of negative factors. First, Nissan discontinued the diesel variant that was supposed to be the model's differentiator. Then, professional reviews consistently ranked it behind every competitor in almost every category. But the final nail in the coffin was Nissan's recent announcement that the entire Titan lineup will be discontinued after 2024, effectively declaring to the market that this truck has no future. What's particularly brutal about the Titan XD's depreciation curve is its acceleration over time. While most vehicles experience their steepest depreciation in the first year and then level off, the Titan XD starts with normal first-year depreciation and then accelerates downward in years 3 to 5 as market awareness of its problems spreads. This inverted depreciation curve is extremely rare in the automotive world and signals a vehicle that the market is actively rejecting. Auction data reveals an even grimmer reality. Dealer trade-in offers are now coming in 10 to 15% below even these depressed book values, as dealerships simply don't want these trucks on their lots at any price. This is what happens when the market collectively decides a vehicle simply shouldn't exist anymore. 2. Ford F-150 Lightning, the EV collapse. The Ford F-150 Lightning entered the market with unprecedented hype. Waiting lists, dealer markups, and early adopters willing to pay $20,000 plus over MSRP to be first. Less than 2 years later, it represents one of the most dramatic value collapses in truck history, with owners losing approximately 50% of their investment in just 24 months. The numbers are staggering. Early Lightning buyers who paid $80,000, often after dealer markups, now find their trucks valued at $40,000 to $45,000. This isn't gradual depreciation, it's a financial cliff that has erased tens of thousands of dollars in value virtually overnight. What caused this unprecedented collapse? In a desperate attempt to boost slowing sales, Ford slashed new Lightning prices dramatically in 2023 by up to $10,000 on certain trims. This price cut created a devastating cascade effect through the used market. Overnight, late-model used Lightnings became hopelessly overpriced compared to discounted new models with full tax credits and warranties. Adding insult to injury, early Lightning buyers didn't just overpay for their trucks, they essentially funded Ford's EV experiment, only to watch the company devalue their investment. Auction data shows Lightning values still haven't stabilized, with wholesale prices continuing to drift downward as demand remains tepid compared to supply. The Lightning's collapse represents a painful lesson in early adoption. Being first doesn't just mean paying a premium, it often means watching that premium evaporate with shocking speed as the market matures and manufacturers adjust pricing to reflect actual demand rather than initial hype. 3. Jeep Gladiator, the overpriced joke. The Jeep Gladiator arrived with tremendous fanfare as the Wrangler pickup truck that enthusiasts had demanded for decades. Its distinctive styling and Jeep heritage commanded premium pricing from day one, with well-equipped Rubicon models easily crossing the $50,000 threshold. But the market has delivered a harsh verdict on its actual value. After 5 years, Gladiators retain only about 40% of their original price. The math is painful. A $50,000 Gladiator Rubicon purchased new is now worth approximately $26,000 to $28,000 after 5 years, a loss of over $22,000. This 60% value bleed outpaces almost every competitor in its segment by a substantial margin. What's particularly troubling about the Gladiator's depreciation pattern is how it's accelerated over time rather than stabilized. Initial depreciation was actually less severe than average, as limited supply and novelty factor kept values relatively high. But as production ramped up and initial enthusiasm waned, values began a steady decline that has since accelerated dramatically. The catalyst for this acceleration has been aggressive discounting of new Gladiators. Dealers struggling to move inventory have offered discounts up to $12,000 below MSRP on new models, creating a destructive ripple effect through the used market. When consumers can purchase a new Gladiator for less than a 2-year-old used one, the entire pricing structure collapses. Dealer auction data tells an even more troubling story. Gladiators with modifications, extremely common among Jeep owners, face even steeper depreciation, with dealers routinely deducting thousands for aftermarket wheels, lifts, and accessories that owners spent small fortunes installing. The market is delivering a clear message. The Gladiator is an overpriced compromise that deserves neither Wrangler pricing nor traditional truck resale values. 4. Ram 1500 Classic, the rental dump special. The Ram 1500 Classic represents a unique case study in how fleet sales can utterly destroy a vehicle's resale value. While the standard Ram 1500 maintains decent resale value, the Classic variant, which Ram continues selling as a lower-priced alternative to the redesigned model, experiences catastrophic depreciation of approximately 50% within just 5 years. For owners, this translates to a financial bloodbath. A $45,000 Ram 1500 Classic loses $22,000 to $25,000 in value in just 5 years, with the steepest drops coming in the first 2 years of ownership. This depreciation rate significantly outpaces the standard Ram 1500, creating a value gap that grows wider each year. The primary culprit behind this collapse is fleet dumping. Rental car companies and commercial fleets purchase these trucks in massive volumes at heavily discounted rates, then systematically flood auction lanes with thousands of identical vehicles after 1 to 2 years of service. This creates periodic tidal waves of supply that overwhelm demand and crush values across the entire used market. Auction data reveals the brutal mechanics of this cycle. When major rental companies like Enterprise or Hertz execute their regular fleet rotations, wholesale Ram Classic prices can drop 15 to 20% in a single month. These periodic supply shocks prevent the market from ever stabilizing, creating a permanently depressed value proposition for private owners. What makes this situation particularly ironic is that the Ram 1500 Classic is fundamentally a good truck, reliable, capable, and well-designed. Its depreciation has nothing to do with its quality and everything to do with business practices that prioritize fleet sales over resale value. For consumers, it's a painful lesson in how mass fleet sales can turn even a good vehicle into a terrible financial investment. 5. Rivian R1T. The tech bubble burst. The Rivian R1T entered the market as the darling of automotive journalists and tech enthusiasts with a $90,000 plus price tag justified by its innovative design, impressive performance, and Silicon Valley pedigree. Less than 2 years later, it's experiencing a value collapse that has owners and industry analysts alike in shock, with projected depreciation reaching approximately 57%. The numbers paint a bleak picture. Early R1T buyers who paid $90,000 for well-equipped models are now looking at projected values around $38,000 as the vehicles approach the 3-year mark, a loss of over $50,000 per vehicle. This isn't normal luxury vehicle depreciation, it's a market correction that suggests the initial pricing was wildly detached from economic reality. Multiple factors are driving this unprecedented collapse. First, Rivian's well-publicized service delays have created legitimate concerns about the ownership experience, with some owners reporting months-long waits for basic repairs. Second, as the vehicles age, warranty concerns are growing, particularly regarding battery replacement costs that could exceed the value of the vehicle itself. Perhaps most significantly, the initial hype around electric trucks has given way to a more sober market assessment. Range anxiety, charging infrastructure limitations, and towing-related energy consumption have all tempered enthusiasm, particularly among traditional truck buyers who prioritize utility over novelty. Auction and private sale data reveal a market still searching for bottom, with values highly unstable and continuing to trend downward. Private sellers are routinely accepting 15 to 20% below asking prices just to move the vehicles, creating a negative feedback loop that further pressures values downward. Early Rivian buyers are learning an expensive lesson about the true cost of innovation. Being first means absorbing the financial impact of a market that's still determining what these vehicles are actually worth, rather than what their creators believe they're worth. 6. GMC Sierra Denali, the $40,000 vanish. The GMC Sierra Denali represents the pinnacle of GM's truck lineup, with premium materials, cutting-edge technology, and a price tag to match, easily crossing $85,000 for well-equipped models. Yet this luxury truck hides a devastating financial reality: depreciation between 43 to 48% within 5 years, translating to approximately $40,000 in lost value. This rate of depreciation means a Sierra Denali loses value equivalent to a brand new Honda Civic during its first 5 years of ownership. Put another way, you could buy a new Toyota Camry, drive it off a cliff, and still lose less money than you would driving a Sierra Denali normally for 5 years. What makes the Denali's depreciation particularly painful is that it starts from such a high price point. While the percentage loss might be comparable to some competitors, the absolute dollar amount lost is crushing. Approximately $40,000 evaporated over 5 years, with the steepest drops occurring in the first 3 years of ownership. The Denali's rapid value decline stems from several factors. First, luxury truck features age poorly compared to the mechanicals. Leather shows wear, screens become outdated, and electronic features develop glitches. Second, GM's aggressive update cycles mean a 3-year-old Denali often looks visibly outdated compared to current models. Finally, the luxury truck market is increasingly competitive, with newer entries from Ram and Ford continually raising the bar and making older models seem less desirable. Auction data reveals another troubling pattern. Denali's experience value cliffs that coincide with major redesigns or updates. When GM releases a significant update to the Sierra lineup, previous generation Denali's can lose 10 to 15% of their value virtually overnight as the market adjusts to their suddenly outdated status. The Denali's depreciation story serves as a stark reminder that luxury trucks combine the worst aspects of truck ownership, size, fuel consumption, with the worst aspects of luxury vehicle ownership: rapid depreciation, expensive maintenance, to create a uniquely destructive financial proposition. 7. Chevy Silverado 1500, the warranty cliff. The Chevrolet Silverado presents one of the most unusual depreciation patterns in the truck market: a relatively normal value decline during the warranty period, followed by a sudden steep drop as the factory warranty expires. Overall, Silverados lose approximately 43% of their value within 5 years, but this number masks the dramatic cliff that occurs right around the 60,000-mile mark. For owners, the financial impact is significant. A $50,000 Silverado will be worth roughly $28,500 after 5 years, but the path to that value isn't gradual. Instead, the truck might maintain relatively strong value until reaching 60,000 miles, then suddenly drop 15 to 20% within a matter of months as it crosses that threshold. The primary driver of this unusual pattern is growing market concern about the reliability of certain Silverado powertrains, particularly the 6.2-liter V8 engine. While these engines perform admirably within the warranty period, repair data shows a significant increase in major issues just beyond the warranty threshold. This pattern has created legitimate anxiety among used buyers and dealers alike. Auction and wholesale data confirm this effect. Silverados with 45,000 to 55,000 miles command significantly stronger prices relative to their age than nearly identical examples with 65,000 to 75,000 miles. This warranty cliff creates a unique trap for owners who often feel compelled to sell before crossing this threshold or risk a sudden value plunge. What makes this situation particularly notable is that it represents a significant shift in Silverado value patterns. Previous generations maintained more consistent depreciation curves, suggesting that the market has identified reliability concerns specific to current models. For owners, the message is clear. The resale hit isn't gradual. It's time to the end of factory protection. 8. Toyota Tundra 2022 Plus. The unthinkable. The inclusion of a Toyota truck on a list of rapid depreciators would have been unthinkable just a few years ago. Toyota's legendary reliability has historically translated into class-leading resale values, with Tundras and Tacomas routinely losing only 25 to 30% of their value after 5 years, far better than any competitor. That paradigm has been shattered with the 2022 Plus Tundra, which is experiencing depreciation rates that have shocked Toyota loyalists and industry analysts alike. While still too new to establish definitive 5-year figures, current trends suggest depreciation significantly worse than Toyota's historical norms, with values already trending 10 to 15% below projected curves. The catalyst for this unprecedented situation is no mystery. Widely publicized issues with the Tundra's new twin-turbocharged V6 engine have created serious market concerns. Multiple recalls addressing fuel system problems, turbocharger failures, and wastegate issues have damaged confidence in a brand that built its reputation on bulletproof reliability. The market response has been swift and severe. Used car managers report that Tundra trade-ins are now regularly coming in below Kelley Blue Book values, with some dealers applying risk discounts of up to $5,000 below book value on higher mileage examples. Private sellers report similar experiences, with buyers demanding significant discounts to compensate for perceived reliability risks. What makes the Tundra situation particularly significant is how it challenges one of the few remaining constants in automotive valuation: Toyota's resale advantage. If even Toyota can't maintain its value edge after quality missteps, it suggests a market increasingly unwilling to pay premiums based solely on historical brand reputation rather than current product reality. When Toyota truck resale cracks, it signals a fundamental shift in how the market evaluates perceived quality versus actual quality, a development with implications far beyond this specific model. The truck value collapse we're witnessing isn't just about individual models. It represents a seismic shift in the economics of truck ownership that affects millions of Americans. With the average new truck loan now stretching to 72 months and often exceeding $60,000, these accelerated depreciation patterns are creating a perfect storm of negative equity that will haunt owners for years. Consider the financial implications. A truck that loses 50% of its value in 3 to 4 years while being financed over 6 years creates a situation where owners are underwater on their loans for most of their ownership period. This negative equity trap prevents trading in or selling without bringing thousands to closing, effectively locking owners into vehicles they may no longer want or can afford. The impact extends beyond individual finances to the broader automotive ecosystem. As more truck owners find themselves trapped in negative equity positions, trade-in cycles slow, affecting new vehicle sales. Dealers facing increasingly risky used truck inventory adjust by offering lower trade values across the board, further pressuring the market downward. Perhaps most concerning is how these depreciation patterns are changing the fundamental value equation of truck ownership. The traditional justification for trucks' higher purchase prices was their superior longevity and value retention. When that advantage disappears, the entire financial case for truck ownership is called into question, particularly as interest rates remain elevated and fuel prices unstable. The truck value collapse we're witnessing isn't a temporary aberration, it's the new normal, driven by fundamental shifts in the automotive landscape that manufacturers and dealers don't want to acknowledge. What makes this situation truly remarkable is how it inverts traditional wisdom about vehicle depreciation and value retention. For decades, conventional wisdom held that trucks depreciated more slowly than cars, that American brands were closing the gap with Japanese rivals in terms of value retention, and that premium features justified higher purchase prices. The data now tells a completely different story. Trucks are depreciating faster than many passenger cars. The gap between American and Japanese brands is widening, with the exception of Toyota's current struggles, and premium features actually accelerate depreciation rather than enhancing value. What's truly revealing is how deliberate industry practices have created this situation. Manufacturers have engaged in a dangerous game of continuous price increases while simultaneously undermining the used values of their own products through aggressive incentives, frequent redesigns, and shortened product cycles. The result is an unsustainable market dynamic where new trucks become increasingly expensive while used values collapse at an accelerating rate. This revelation challenges the core marketing narrative that trucks represent investments or superior value propositions compared to other vehicles. The data now clearly shows that in many cases, trucks represent a more destructive financial proposition than even luxury cars, combining high initial prices with rapid depreciation to create maximum financial damage. Today's truck market isn't what dealerships and manufacturers want you to believe. Behind the rugged marketing images and promises of capability lies a financial reality that's destroying owners' equity at an unprecedented rate. The trucks we've examined aren't just experiencing normal depreciation, they're undergoing value collapses so severe they redefine what vehicle depreciation can look like. From the Nissan Titan XD's 65% 5-year value erasure to the Ford F-150 Lightning's 50% collapse in just 24 months, these patterns reveal a market undergoing fundamental reassessment of what trucks are actually worth versus what manufacturers and dealers claim they're worth. Whether it's the Jeep Gladiator's 60% value bleed or the GMC Sierra Denali's $40,000 vanishing act, the financial damage is real and getting worse, not better. The data doesn't lie, even when marketing departments do. Understanding these depreciation dynamics isn't just interesting information, it's essential financial self-defense in a market designed to separate you from as much money as possible while providing as little transparency as necessary.